Let's go to the permanent discussion here that's always going to be with us year after year, and let's talk about what we think happened this year, what we expect or think is going to happen next year. Large cap value, growth, and dividends. First, the comparison of performance. I'm going to pop up the slides after the data here to show everybody, the growth value and dividend performance year to date looks similar. If you take a look at that left-hand chart, around 19, 20, 21%. However, look at what happened in the last 3 months. Value didn't do very much. Dividends did more, growth did even more. Value had a pop in the first quarter. That's really when value had a run. And a lot of that was driven by, it's called the expectation of an economic recovery, oil prices going from negative to zero to positive, now sort of in that, let's say the 60-ish dollar barrel, $70 barrel zone. However, what's been steady is both growth and dividends. And we would suggest to people who are really interested, take a look at quality dividends, because quality dividends, at least in the case of OUSA, OUSM, the O'Shares products, tend to exclude some very volatile sectors like oil and gas, very, very much lower allocations also to some of the financials that are quite volatile. So it's a steady approach to dividends. If you look at the right-hand chart, you'll see the money flows. And value brought in a lot of money in Q1, Q2, and then the money flows essentially went to zero for Q3. Whereas you got steady money flows into the dividend strategies and a reversal on growth from negative to positive from Q1, 2, and 3. So that's the story on performance and money flows. So let's talk about what you think happened this year, Kevin, in 2021, and your outlook for 2022, value, growth, and dividends.
The biggest problem, and this has been a multiple decade long problem for investors, people are always pitching me value ideas. And here's why I don't invest in them. This is a personal opinion, but let me give you an example. A stock like Kmart, that's one I love to use as an example, a failing business model, a poorly managed company, if you wish. As its stock trajectory starts to decline as more and more investors exit and institutions exit because maybe the quarterly numbers aren't sustaining what the metrics were that they originally invested in, the stock starts to decline and becomes cheaper. At some point, it's considered a value stock because it's gotten so cheap, but it just stays in that range for a while on its way to zero. And so when you buy value, which is what happened with Kmart, when you buy value, your market timing, you're deciding that something's going to change for the better in a name that went from a successful stock perhaps down to a difficult situation. Another good example would be GE. General Electric used to trade in the 60 to 70 range, and I think it lives in purgatory in the 13 or 12 or whatever. I don't even look at the stock anymore. I would never buy that. And I'm not saying it's going to zero, but somebody lost a lot of money calling that a value stock on the way down from 60 to 13. Another group would be the airlines. The airlines are in their balance sheets are upside down. They United had 8 billion of debt. Now it's got over 20 billion of debt, and that happened in a matter of months. Why would you ever buy that is my point. And that's considered a value stock. There's so many other places. I'm not saying United goes to zero, but its best days, in my view, are well behind it because people don't do business travel anymore and a lot of other issues. So I don't like value. It has its moments. It runs up for a few months, and then people say, "Why do I own this garbage?" And they dump it again. And so I don't mean garbage. Actually, I do. It's garbage. And so I don't buy that. I would rather buy companies that have successful business models that are growing their free cash flows. And that's my investment thesis. There is no room for whatever value wants to be. Value is just a stock on its way to hell. That's what I look at.
So you're staying away or underweight on fixed income and staying away from value, certainly generic value, which leaves you with growth and dividends. Just tell people your philosophy on dividends and why quality dividends instead of just high dividends or all dividends.
Well, the risk you have if you start buying stocks with 7 and 8% dividend yields, there's a reason for that. The stock prices decline dramatically because some percentage of the user base may consider the dividend might get cut, and often that's what happens. Dividend yields of 2 to 3% in companies that have stable business models, that have free cash flow, that are not using debt to pay dividends, in my view, are worth investing in, because you have the potential of the capital appreciation of the underlying security, the stock, in addition, your fair share of the distributions of free cash flow in the form of dividends, which is basically the profits. That's a very long-term strategy for me. That's exactly why OUSA is it's a dividend strategy, but really focused on the quality of the balance sheets. And that's my core holding. That's 40% of what I do in equities. And that's just a baseline of the subset. I don't want to own the S&P 500 because there's a lot of broken companies in there, particularly past the pandemic, the airlines I mentioned, for example. I'd rather own the ones that pass the rules-based test of really high-quality balance sheets. And they tend to be less volatile and maintain their dividend distributions, which is what I want, because 2 to 3% is almost half my bogey of distribution of 6% a year. So if I can get some of that in dividends, I'm very happy.
And if the company can keep on growing, and then your dividends will keep on growing. We had an advisor recently comment that they were pleased with the consistency of performance of OUSA and the stocks that are in there. And that is what you get when you focus on quality.
Yeah, I said earlier, it's boring, and I love boring.
Well, if you're trying to replace some fixed income, you probably want to stay somewhat boring with that zip code. And then let's talk growth versus quality dividends. I mean, how much growth do you want in your portfolio? How much do you want in quality dividends? What's your thought going into 2022?
Well, I'm sort of 20% in growth and the rest in quality dividend. If you look at my equity portfolio, more or less. I mean, I do have venture investments, but I mark to market those at zero sometimes because the outcomes are unknown. That's not the core of my holdings. All the Shark Tank stuff and everything else. I'm happy to support entrepreneurs, but I'm talking about where the real money is here. And basically 20% is in growth. Now, growth to me are companies that have strong balance sheets. They don't necessarily pay distributions because they're plowing back their profits back into growing, but they're growing at 20, 30, 40% a year. And you find them globally, and you'll find them in an index called OGIG. I talked earlier about OGIG. It's a 20% holding for me. It's got more volatility, but the rules for picking those companies are different. It's not just about distributions. It's about, can they sustain the revenue growth that they're showing? And so there's many companies around the world that are helping to digitize the world that are very, very high growth companies. And I want to own those for 20%. But so it's really 80-20. When you look at 80% is quality div, quality balance sheets, 20% more volatile growth inside of OGIG.
And one of the things about the way you express asset allocation is consistency. Your 80-20 is straightforward. It's consistent. I think people maybe look into that and learn from it. So on this segment, I just conclude by inviting people to send us a note, info@oshares.com, if you'd like more information on what Kevin's just been talking about, his asset allocation, or if you'd like some of the data that we've shared with people in the early part of the segment.